Hi everyone, hope you're all doing well. Today we're going to talk about Greg's highly requested. It was very popular on the Discord yesterday, and a lot of us were talking about it on the Discord if it's an opportunity to buy. And thank you for all the new members as well that have been joining through the Patreon and getting access to the Discord. Just a quick shout out because a few people actually don't realise this. So always do it on the web browser than your iPhone, because then you don't have to buy or pay the iOS fees from Apple. And the other thing is, if you do want it a little bit cheaper, what you do is, if I go and become a member, and then you've got the join patron, £6 a month. If you pay yearly, then you get 15% off, as you can see here, which £5, 10 pence, price of a coffee every month. It's not too bad, and obviously I hope for the information I give you guys, it's worth it, and thank you for you guys that support the YouTube channel. But yeah, obviously a lot of big discussion on the Discord about Greg's yesterday, and I saw it in the comments section as well. I must have got a good 7 or 8 questions on Greg's, on new videos, old videos, like can I do a bit of an update on what I think with Greg's, and today we're going to go for that. So Greg's, I'm sure we all know what Greg's is. I mean, there must be at least one near where you live, sometimes multiple ones near you live. Sometimes I look at Greg's and some of the locations near each other and I go, how's that one opening up when that one's down the road? But they seem to work, and yeah, I'm sure everyone in the UK is pretty well known with Greg's, unless you are from outside the UK. Luckily enough for me, I think 90% of my audience is UK based, but obviously the bakery shop Greg's that's in the UK, very successful bakery as well in the UK. Yeah, tick symbol GRG. It's currently a 1.7 billion market cap. Bakery worth over £1 billion, eh? 11 times earnings. Just be a little bit careful on that earnings, because it's a bit skewed because the profit's about to drop. So technically that earnings is going to be a little bit higher. The dividend yield has pushed up to a 4%, which has got to be one of the highest that Greg's has been for a relatively long time. And I used to be a shareholder of Greg's. I don't know if any of you guys were watching the YouTube channel when I used to own Greg's, but you can see here, look at that. How young looking is that? I used to be a Greg shareholder around about 5 years ago, as you can see here. That's when I actually first started buying Greg's during the whole CV situation. Yeah, was actually my largest UK position. I ended up selling out of Greg's, and we made really good money from it. So looking at it now, is it a time to go buy Greg's? Well, if we do look since September time, the 13th of September 2024, the stock has had a tough time. The stock is actually down 45%, which is pretty significant. We haven't seen historically that many drops from Greg's. The only drops that have been very similar are kind of that CV drop, as you can see here, and then we had that big inflationary environment situation, but even then it didn't drop that much. So really the only other time is really the CV drop. Historically been a great performing stock on the UK markets as well, up nearly 2,800%. Some people say UK stocks are not the place to be. Well, Greg's kind of breaks that trend, because 2,800% return is definitely a very good return. So why did the stock drop? Well, the stock's actually been dropping for a significant amount of time, actually, to be fair. If we do zoom out, you can see this wasn't just a drop that's recently happened. It's really a drop that's been building up for the last year. Reasons why? Well, obviously the recent drop we'll cover in a second, but before that, I think there's been struggling growth, struggling like-for-like growth, and high cost pressures. We've seen the current UK government obviously force a load of extra cost pressures onto some of these high employing companies. We've seen the consumer environment get a little bit weaker. People are willing to spend less money. We've seen higher likes of stealing as well, and Greg's have pointed that out to something that is impacting them at the moment. But the recent drop was because of the update here. So they did a trading announcement for the first half of 2024, which was posted on the 2nd of July. So sales were up 6.9%, which is not too bad at all. Like for like was 2.6%, which is okay. The only issue they have is that Greg said they were going to get to 6% by the end of the year, which is obviously looking quite hard to achieve at the moment. They said that one of the reasons why is because of higher temperatures. Now, I'm not a big fan of blaming the weather. Every so often I can allow the weather to be maybe blamed for a situation, but I'm not having that, because what we saw Greg's do in the last update is they actually blamed the weather for being poor, and now they're blaming the weather for being too hot, which I don't agree with. I've been on the high street, and the high street's been, and with this warm weather, has been the busiest I've ever seen it be, so I don't understand why that would affect the sales, and we've seen it before with the likes of the credit card data. The credit card data at the moment is showing that, like, these sort of locations have actually been doing very well. So blaming the weather doesn't really sit with me, because you can't blame it for being too awful and then it being too hot. It was fine in April and May when we had warm weather, and then all of a sudden it's the weather's fault now in June when it's just been exactly the same as the previous months. So yeah, not a big fan of that one. So they also said they have 31 net store openings. So that's obviously one of the things that is going to help them, is opening up new stores and obviously getting those like-for-like sales up, whether that be through price rises or just general increasing. My concern about the like-for-like sales is that one thing they're trying to do is they're trying to combat the stealing at the moment. So that I think they're trying to put a lot of it behind the counter. Now, my concern for like with that situation is that if things are behind a counter, there's a lot of situation where you're waiting in line and you're looking at things and you go, actually, you know what, I'm going to get that, and you pick it up on the way there and you're looking at, when you get to if you can't see it when you get in, and then you get to the till and everything's behind the till, you're rushing to get your order in and going this and this and this, and then you might feel a bit awkward sometimes going, you go, oh, can I have that and that, and then you think, oh, you know what, I might have had that, but I've got to ask someone, and I'm not asking them again to go get something over there. That's one of my concerns around the like-for-like growth as well, is that, to combat the stealing, they're putting a lot of things behind the counter. Is that going to impact like-for-like growth, because it's going to be harder to get to things, harder to see things, and a little bit more awkward just to ask for people for a few things, like, oh, what's that new thing you've got down there? That's another concern that I do have as well with this situation at the moment. 31 net openings and the aim for 140 to 150 per year. That's going to be the major driver for them, is opening up new stores. However, they said the board now anticipates that the full year operating profit could be modestly. That's always a key word, isn't it? Modestly. What's modestly? Are we talking 1%, 2%, 4%, 6%, 7%? That's something that always makes me a bit nervous, is like, what is modestly? So yeah, below what is achieved in 2024. Once again, they talked about the weather there. So yeah, overall, I looked at Greggs and I thought, not the best update from them. And there's definitely a few concerns that I have with Greggs at the moment, with what's kind of going on. So one thing that I personally think about Greggs is that I think Greggs is peaking a little bit now. I know people have been saying this. I've criticised people for saying this a few years ago, when people saying, oh, there's no more room for them to grow. And then we've seen them carry on growing like this, which has been amazing. But the growth looks like it is slowing down, 23%, 19%, 11%. This year, I can't remember what the growth is expected for this year. Is it like 6%? 2 billion up to 2.1. Yeah. What's that, about 7%-ish? So it's still okay, but it's slowing down, and it's certainly not from, the levels that it were. Let's just go from 2019, before the whole CV numbers and all the inflationary numbers, 13%. So it is slowing down from where it was previously. So that's a concern. And the thing that I always say is, when you're valuing a company, Greggs has always been valued. I don't think I've actually got a Greggs P ratio here. Actually, let's go on Simple Wall Street here, and let's have a quick look at this valuation of Greggs. Where's the P ratio gone here? So, I mean, Greggs has historically traded at 20 times earnings, which a few people have criticised that, but I've always said it's one of the best run UK businesses, and to be 20 times earnings is probably about fair for it. The problem I have now is that if their growth is slowing from double-digit growth down to 6-7% a year, in my opinion, you're not going to be trading at 20 times earnings anymore. You are going to have that metric compression. And I think Greggs is going to go to a period now where it's still going to be a decent company, because it's still very good. I make it sound like I'm negative on Greggs, but I still think it has a very good future, and it's going to continue to grow. It's just that the growth rates are compressing a little bit now, and because of that, your metric, when you're growing faster, you trade at more of a premium. If you're growing slower, your premium comes down. And I think Greggs has maybe seen the times where it used to grow at 20 times earnings. I do feel like Greggs is going to compress down to maybe 15 times earnings now, and that's something that I think you've got to bear in mind with Greggs at the moment. Now, I could be wrong, and if it goes to 20 times earnings, shareholders are going to be very happy, but that's also something that I think could change with Greggs. The other issue that I have with Greggs at the moment, obviously, is the slowing amount of growth. But when we look at the guidance, I'm going to go to Simple Wall Street actually for this because they have a bit of a longer term forecast here on what's going to happen with Greggs. So they're expecting the EPS drop here to drop quite significantly. So this is what I mean when we're looking at this P ratio at the moment, like 11 times earnings. It's probably not correct. We're probably going to see the P drop to something a little bit more. I don't know if we have the P without me having to do the maths of Greggs at the moment. So they're saying 12 times earnings, but I don't know if these are the updated numbers here. But the PE is going to go up because of the drop in the EPS. And analysts at the moment are actually forecasting it. If we look at 2027 numbers, we're not actually going to see them surpass their old EPS for 2 years as well, which is quite significant at the moment. The other thing with Greggs that I've always been a bit disappointed with is they've never expanded as much as what I thought they could do. So obviously international expansion, it's a little bit risky, and would a bakery chain be welcomed as much as what it's in the UK and other countries? They did try it before. Was it in Belgium? Yeah, Belgium, and they didn't do that well. But there's got to be certainly an area where Greggs maybe can expand to a little bit more. I always felt like maybe they could have bought someone like a Cake Box. So the lack of it's okay opening up more and more UK venues, but I feel at some point they're going to start overlapping each other. And that time's going to come. And I think we're maybe seeing it now with that lack of growth at the moment. I've always been surprised that Greggs have never expanded the range a little bit more. That's always been something that I found disappointing, which I think they could have done a little bit better. The other thing that also is key to point out is that they did have a bit of a CEO change. So previously, one of the main reasons why I was buying Greggs previously is because of the old CEO, which was Roger Whiteside. I felt like he was doing, he had the last 10 years under his management was unbelievable. He did so well. And then they brought the new CEO in, and I don't like CEOs that basically just copy what the old CEO does. I want them to bring something new and exciting to the business. And I feel at the moment, the new CEO hasn't really done that. And they've been in place now, I think, is it 2 years, 3 years? And it seems like they're just kind of copying the same thing. And like I said, I want them to bring something new to the scene. And it seems like they haven't, all the old ideas are off all the, the old CEO with Roger Whiteside. And, I want them to do something a bit different. And that, hasn't happened at the moment. So probably another sign as well that this was going to go a bit downhill is obviously the CFO. The CFO actually did sell a good chunk of shares, nearly 1.9 million of shares in October. So maybe that was a sign, because that was very much before the drop in the share price. If we look here, yeah, really before the significant drop here. So I guess that's sometimes the key to be some insider buying, insider moves. What I would like to see really now is that the stock has fallen that much. I mean, the stock is down what did we say, 50%, 40%? And no insiders have come in and bought. That's quite strange to me. I would expect after this significant drop, if you felt like you were going to be okay for the future, you'd feel like some insiders would be coming in and buying right now. And at the moment, we might see some in the next few days. We never know. But there hasn't been any insider buys coming in at the moment, which makes me a little bit nervous. If they think it's going to get better from here, why are they not buying at the moment? So, and that comes back to the point of view that maybe this is kind of a bit more than a weather thing at the moment. But let's look at some numbers, because I made it sound quite negative there on Greggs, but those are just some concerns that I'm seeing. I mean, overall, I think Greggs can continue to do well. If it opens up new stores, that will give it, decent amounts of growth. But what I would say is that I just feel like Greggs is maybe not the same level as what it was when I was last buying, 5 years ago, in my opinion. But let's look at some numbers here. So I put Greggs down. It helps if I spell it correctly. So I put 4-6-9% revenue growth in if they're able to get up to a bit more higher growth here. And 6-7-8% profit margins. I am expecting some metric compression because the profit margins are expected to drop. But at the same time, this is a 5-year forecast, so I'm also pricing in that they're able to drag up those profit margins maybe a bit in the longer term with efficiencies, stop the stealing, some new factories, more automation coming in. So they might be able to drag up to a bit more of a higher profit margin by a percent. We'll see. 15 times earnings in, because like I said, in my opinion, we're going to see the metrics compress a little bit on Greggs going forward. And on the numbers, 15% on the low side, 44% on the mid side, 84% on the high side. I mean, it's okay. It's okay. like I said, I from from the video so far, it sounds like I'm quite negative on Greggs, but I think it's a good company. I just think that it's not the company it was 5 years ago, and you've got to price in that risk to reward. And as they continue to open more stores, that will drive growth going forward. Hopefully, they combat some of the issues they do have, and if they do, they'll grow at okay rates. But I think it's very different from when we used to talk about Greggs like a double-digit growth company down to mid to high single digits. And a bit more of a metric compression. I mean, overall, if you factor your dividend in on top, which is what, a 4% yield, 4% times 5, 20% return on your dividend alone, and probably they'll keep on hiking that up as well, to be fair. So if you had 20% on top there, it's not too bad on the mid side, it's not too bad on the high side. You're around about, what, 60 to 100% return. It's not too bad. The only thing for me is I like, when I'm investing, I want my risk to reward to be in my favour. And I'd look at that at the moment, and the numbers are okay. Like, if you're buying Greggs at these levels, like, I'd rate Greggs a buy. Just the problem for me is I look at it and I go, there's just not, looking at where the stock is right now, I'm just not seeing the upside. Well, I am seeing the upside. I'm not seeing enough for me to justify buying right now. That's the problem. I probably would want to see this high side over 100%, and I'd like to probably see that mid side closer to the 100% range for me to buy to justify it. You could argue case, what happens if Greggs does go back up to like a 20 times earnings multiple, and the market values it like how it did previously? You know what? If you believe it'll go back to where it normally trades at, you're buying this all day. My concern is that the metrics are going to compress a little bit from previous because the growth's slowing down a little bit. So, if you disagree with me, and then I think you're a buyer here. The problem is, like I said, I think the numbers, the valuation is going to compress a little bit, and when that does happen, it's just not as attractive. I could buy Greggs. I could easily buy Greggs. The only issue is that I would need to see that middle number and that high side number come a little bit more in my favour. And then if the valuation does compress, I still make a decent amount of money. For me, it's not a million miles away. Like I said, I think I made a bit of an error with this video because I made it sound like I'm quite negative on it, and I'm not. I'm just concerned that there's a few issues going on at the moment, and that's just to get your risk to reward balance correct. I think really you're looking at maybe like another 10-20% drop. If we do, let's say let's meet in the middle. Let's say 15% drop on Greggs right now. And there you go. So 70% on the mid side, add your dividend up, you're up to 90%. On the high side, you're up to 130, 140% return there. That is, that's good for me. I like that. So when I'm looking realistically, Greggs right now, I think I'd rate it a buy. However, I'm not seeing enough upside for me to buy personally. I just want a bit more upside. Where that would come a buy would be another 10-20% drop. Obviously, I showed you a 15% drop. So yeah, I mean, I'm looking at Greggs and thinking that I like it. I just probably want it a little bit lower, and that would mean it dropping somewhere probably towards like the £15 mark. And it wouldn't be awful. It wouldn't be hard for it probably to drop 10-15%. If they come out with another, let's say Q3 doesn't bounce back as what they're hoping for, then maybe that would lead to the 10-15% drop. Maybe some, the economic data gets spooked, tariff news spooks it, some news about the UK inflation spooks it. There's certainly ways that this could easily drop into that level. So I'm kind of like on the fence of like, I'm not going to personally buy, but I'm watching it. And if you give me another 10-15%, don't be surprised if I do add it into the portfolio, and that's where it would come. The risk to reward for me would come in, and I'd be happy to buy it. But yeah, I like it. They just need to continue opening up new stores, keep that like-for-like growth going up in the right direction. I have concerns. I have concerns about this, dealing with this, all the stuff that's going on with the stealing situation and what that would mean for the like-for-like if it's behind barriers in the desk. And I have concerns on just the economy in general and how much, probably more tax rises are going to come. Is that something that's going to affect Greggs? How much, there's not really a clear... They'll get away with expanding stores for the next couple of years, but I think ultimately they need to find a new driver for growth. You know, they've had them previously by extending their hours. They've had that previously with the likes of Uber Eats and Deliveroo. I think they need the next kind of, this is going to be a key driver for the next 2 or 3 years. And at the moment, I can't see where that's exactly coming from at the moment. So for me, all that just needs to balance into, and I believe the valuation will compress a little bit more from where it's historically traded at. We'll see if I'm right or wrong on that. But for me, like with all those little risks that are here, I just want a bit more risk to reward in my favour, and that's where I'd buy. So hopefully that kind of clears it all up. And like I said, the video overall sounds like quite negative on Greg's, but I like it. I just need more reward to the risk here to buy. But I think if you do buy it, I think you'll do well. It's just I like to see a bit more bigger rewards than this, and for that to happen, it just needs to drop a little bit more. So that's the video for Greg's, guys. Hope you enjoyed it anyway. Thanks for watching. See you in a bit.